Good morning, ladies and gentlemen. There's a lot of new people in the room now. Welcome to the show, streaming today through Thursday. Steve is in the room to open up the show with why the stock market will be in trouble. I'm going to go ahead and call on Steve now. Are you there?
Good morning, Chantal. How are you?
I am good, thank you, sir. You look great. You sound great. I'm going to go ahead and offer you a proper introduction, and the floor will be yours to get started.
Thank you.
You're welcome. Ladies and gentlemen, please welcome Steve Forbes, Chairman and Editor-in-Chief of Forbes Media, which publishes Forbes magazine with a circulation of nearly 6 million readers. Combined with the company's other licensee editions, the magazine reaches nearly 6 million global readers, and Forbes.com reaches almost 70 million unique monthly visitors. Mr. Forbes serves on the boards of the Ronald Reagan Presidential Foundation, the Heritage Foundation, and the Foundation for the Defense of Democracies. Steve, thanks so much for joining us today.
Good to be with you. Thank you.
The floor is yours, sir.
Well, thank you very much, Chantal, and thank all of you for joining us this morning. Well, as you all know, the stock market has had a fantastic rise since March of 2009, despite some very serious stumbles, most especially what happened in the spring of 2020, where we had an instant bear market and an instant recovery. Even the bond market has done well in the last 10 years. The average annual return in bonds in the last decade or so is 11% per annum per year, astonishing. However, there's some big obstacles out there. Now, obviously, the terrible budget bill looks like it's in trouble in Congress, but there's so many other things that are being done that are going to hurt the economy unless we get some real roadblocks. Fortunately, tonight we have governor's races in Virginia, where it looks like the Republican Youngkin can win. We have a gubernatorial race in New Jersey. New Jersey is a very blue state, so I'm not sure the Republican, who's waged a terrific campaign, Jack Ciattarelli, is going to win, but I think he's giving the incumbent a good run for his money. What these elections will tell you, especially in Virginia, I think will give pause to moderates and Democrats in Congress. There are still a few left who want to keep their jobs and perhaps can take some of the worst features out of these bills. But nonetheless, they may pass something, especially under the guise of infrastructure. And on the regulatory side, there are some very real challenges. But let's focus on one. The Federal Reserve is being in the news. Oh, are they going to slow down the taper and things like that? The thing about the Fed is it gets to us to the real critical subject of inflation. And I think in terms of understanding inflation, it's important to understand there are two kinds of inflation. One is the real reaction to prices in the marketplace or to government mistakes like putting up barriers to doing business, putting on sales taxes, or as they've done in recent months, muck up the supply chain. Those are what you might call marketplace price changes or just normal changes. Let's say we get a report today that if you eat 10 apples a day, you're not going to get sick again and you'll live an extra 15 years. You know what would happen to the price of apples? They would soar until the orchards could grow more apples to meet the market demand. So prices, supply and demand, the kind that you can experience in the normal activities of the marketplace, or government making mistakes in terms of putting up barriers in the marketplace, call that marketplace inflation. But there's another kind of inflation, the kind that we, some of us know from years ago, and that is what you might call money inflation. That is the Federal Reserve printing too much money. What we're experiencing today is a form of monetary inflation and marketplace inflation. It's a mix of both. The Federal Reserve created a lot of new money in 2019 and 2020, which hit the economy. And also, we all know what happened to supply chains during the COVID shutdowns. I'll be discussing those a little more in a few minutes. But if you want to see the monetary kind, the classic case graphically is what happened in the 1970s when the dollar was devalued informally, but nonetheless, it was cheapened and too much money was being created. Confidence was lost in the dollar. And so you look at the price of oil. In the late 1960s, oil was selling at $3 a barrel. By the early 1980s, it was selling at nearly $40 a barrel. That was not because oil was becoming more scarce or we were running out of the stuff. That was largely a reflection of a weak dollar, what you might call monetary inflation. You see it too in other commodities or hard assets in the early 2000s. When the dollar was weakened, you saw oil go from $25 a barrel to $100 a barrel. You saw the housing bubble, which led to the catastrophe, helped lead to the catastrophe of the crisis of 2008, 2009. So in terms of the kinds of inflation that we're groping with now, we're primarily being hit now with what you might call the marketplace kind of inflation. But the danger, and this is the danger for the stock market, is what's going to happen with the Federal Reserve. As you know, the Federal Reserve has been buying $120 billion of bonds each month, massive increase in the money supply. So why haven't we seen even worse inflation in terms of commodities and especially gold? The reason is the Federal Reserve has been engaging in a very unique, unprecedented gimmick. So it buys these $120 billion of bonds and then in effect takes the money, so puts the money into the banking system, which is already flush with cash, and then it removes that $120 billion. How do they do it? Through a device called reverse repurchase agreements, what they call reverse repos. In short, what that means is the Federal Reserve borrows short term. These repos can have a duration of as short as 24 hours. And since in February, the amount of these repos on the Fed's balance sheet, and this comes out every week on Thursday, was zero. Today, it's approaching $1.5 trillion of short-term borrowings by the Fed from the banking system. So they temporarily bottle up this money they're creating, but at some point that dam is going to break. In effect, what the Fed is now doing is taking a bucket of water, pouring it in one end of the pool, then going to the other end and removing the equivalent amount of water in and out. Kind of a crazy exercise, but that's what the Fed is doing to try to keep interest rates low and a severe outbreak of the monetary kind of inflation. However, how long that could continue if Congress does pass one of these big spending bills like that infrastructure bill. Already deficits are running over $1 trillion a year. It's amazing how easily trillion slips off the tongue now. The Fed is going to be even printing more money. Almost 60% of the debt has been financed in effect by Fed money printing. So that's a very real danger in 2022 and 2023. The kind of a monetary inflation we haven't seen. We saw some of it in the early 2000s. We saw it big time in the 1970s. So what this means is, as we know, inflation, that kind of inflation is not good for the stock market. During the late 60s, 1970s, early 80s, in real terms, for example, the Dow fell in real terms by 50%, even though on paper it was kind of where it was in the early 80s as it was in the late 60s. Now, this gets to another kind of thing that you have to watch out for, and that is the rise of Bitcoin, cryptocurrencies. The problem with cryptocurrencies is even though they're developing blockchain technology, which in a few years is going to revolutionize the payment system, make it much easier and cheaper, which will be good news for consumers. But in the meantime, these cryptocurrencies are like wild roller coasters on steroids. And that's not money. It may be fun to speculate in them, but you wouldn't dare take out a Bitcoin mortgage. You know, you may take out a $250,000 mortgage in Bitcoin and find yourself a year later owing $2.5 million. But there's a rise of a new class called stable coins. They're tied to a specific asset like the dollar or gold or some other hard asset. And what that means is that the value of the stable coin doesn't fluctuate. The value of that, in a sense, is that you can use it for day-to-day transactions more easily and long-term contracts. Now, there are a lot of stable coins around, but the challenge there is, do they really have the backing they say they have? Do they really have the dollar assets they say they have? Do they really have the gold they say they have? So before they become a real alternative to currency, as government mucks up the value of the dollar and other currencies, governments around the world, central banks around the world, you have to be sure that the stable coin is the real deal. And that's why they're going to have to show on a day-to-day basis in a transparent way what real assets they have backing up the stable coin in another institution. They just can't say, oh, we have it in the cellar here. No, that's not going to work. We saw with Bernie Madoff where that can lead. They have to be transparent. These assets have to be in depository institutions, and they have to be audited by outside auditors, such as particularly accounting firms. So in terms of the real danger to the stock market, and particularly interest rates, watch the Federal Reserve. Watch what they do on reverse repos. You can get it again on weekly balance sheets. And watch the price of gold. If that starts to move up meaningfully, then you know the bad kind of monetary inflation is with us, as well as the supplied kind of inflation. So this then gets to other challenges. As you know, the Congress is still trying to pass, the left is still trying to pass this monstrous spending bill. And while it is in trouble at the moment, as I said, they can pass a lot of this stuff by other means, especially regulation. But it would be a disaster. Look what they're trying to do in childcare. They want the government bureaucracies to take over and affect childcare. They're going to make daycare almost impossible to do. The kind of operations you have in daycare now in a lot of states, where moms and grandmas bring a few kids over, take care of them during the day, that's going to become illegal. You're going to have government workers, union workers, being in charge of daycare and childcare. You're also trying to do the same thing in the so-called universal pre-K, where again, government unions, teachers unions are going to be in charge of what your child learns. And they're going to try to crush private alternatives on the charitable side in terms of providing early child education or daycare. They're going to do already writing up regulations. They're going to make it impossible for religious institutions to be involved. They want to nationalize it. You know the golden rule. The person who has the gold makes the rules. In this case, where the government has the gold, they're going to make the rules of what your children, grandchildren are going to be taught and how they're going to be taken care of. It is really bad, tyrannical stuff. And that's why that's got to be defeated, even though it has such a nice sounding word to it. The other big thing they're pushing for is a child credit, a so-called child tax credit, which means that you don't get a tax credit, you can get the cash itself. And this is simply a foundation for a universal income, a national universal income. They know they couldn't get that through a straight vote on Congress, so they're doing it by stealth. And so you have something already called, as you know, an earned income tax credit. If you have a low income, in effect, you can get a rebate. It's in effect a rebate on your Social Security taxes. But I suppose designed originally, the EITC, the earned income tax credit, to help people get off welfare without paying a severe penalty. You know, in the old days on welfare, if you started to earn some real money, you lost massively on the benefit side, and therefore was a welfare trap. Well, the EITC is supposed to take care of that. So why do we need this other tax credit, child tax credit? Well, again, they want to put the two together in effect to create the basis for national income and also create more dependency. So they're increasing both the EITC and trying to introduce this $3,000, $3,600 a year cash payments, which is what this thing is designed to do, to people with kids. Work requirement? No, they're resisting that, even though Senator Joe Manchin is onto that and is trying to make sure there is a work requirement. But right now, the far left is trying to slip it in without that. And at the same time, they want to make it the eligibility very, very high to ensnare as many people as possible. So even though the bill is in trouble, they are going to make sure they can get as much of this done by stealth, by sticking this stuff in other parts of other pieces of legislation that pass. As you know, on these programs, once they start, they're almost impossible to stop. People become accustomed to that money, and no politician's going to say, I'm going to take it away. And so, as Ronald Reagan said, the closest thing to immortality in this world is a government program, and that includes entitlements, and that's what the Democrats are going to slip in. So even though this big, gargantuan, monstrous bill looks to be in trouble, they're going to make sure they try to get as much of this stuff in other bills in other ways or through sheer regulation. Of course, we all know what they want to do on the tax side. They couldn't get through a corporate tax increase, which would be paid for, as you know, not by corporations. They're simply the tax collectors, economists of numerous research papers have concluded. Who pays for it? Customers in terms of higher prices, shareholders in terms of less dividends and profits, and of course, workers in terms of lower pay than they would have received otherwise. Nonetheless, they're chattering about putting in, and they hope they still can ram it through, the so-called minimum corporate taxes. Well, that sounds reasonable, minimum tax, but boy, you got to look at the fine print. Already the Biden administration, it wants to change the way companies' international tax payments are calculated on a basis that would effectively raise, for a lot of them, sharply raise their foreign tax liabilities. You all heard about this confab in Europe, where the 136 countries agreed to an international minimum tax. You put those two minimums together, they're going to sock it hard to a lot of American companies. Moreover, the Democrats want to take away the 20% tax credit that was passed in 2017, in the 2017 tax bill that was a real help for small businesses and helping provide incentives, lowering the burden of being successful and providing incentives for more investment. They want to take that away. So again, even though a lot of these things look like they're being sidetracked, they're going to try to sneak them in other ways. And incredibly, Senator Ron Wyden of Oregon, who heads up the Senate Finance Committee, still is pushing the tax on unrealized capital gains, which, as you know, is simply a first step to having a wealth tax, and also a stealth way of empowering and policing the IRS to go through your bank accounts, your brokerage accounts, your PayPal accounts, your credit card accounts. That's what they want to do. So whether they do it overtly or covertly, they want to make the IRS weaponize it. And this gets to not just economics, but politics. If everyone knows that with this complex tax code, it's easy to audit you and to find something that you may have not done right, even though you tried to do it right because of the complexity of the code. When you have 10 million words out there and written in gobbledygook way, it leaves the bureaucrats and the police, the tax police, a lot of room for mischief. And so they'd come to you and say, hey, we'll settle this for you for, say, $500, just sign here and we'll get out of your way. Well, these new IRS agents they want to hire, those agents know their performance is going to be judged by how much money they collect. So they're going to go after middle-class people. They're going to go after small businesses, shake them down each year to make their improvement records look good, and also provide more money for Uncle Sam. You don't have to be a genius, except in Washington, they don't see these things, but normal people would quickly see what this would do to the economy. It would be a crusher. So then too, on the regulatory side, they want to expand Obamacare. Even though we thought we'd try to slay that monster years ago, it didn't happen. They want to kill the private insurance industry through expanding Obamacare, through expanding Medicaid and other regulatory devices. So again, it's not just what Congress does, it's what these people do in the middle of the night. So this then gets to the big issue of energy. Energy is obviously crucial to an economy. It's like blood in a body. You need it. And they're doing everything possible to wreck the fossil fuel industry. So you have the perversion of Joe Biden, our president, begging Russia and Saudi Arabia to increase oil and gas production to take the pressure off of pumps, gas prices at the pump, and also with winter coming up, what's going to happen to winter heating bills? Not good politics, not good for the economy. And yet at the same time, they're doing everything they can to hobble production. The EPA just announced today, that they're going to put on new methane regulations, which will hurt existing wells for oil and gas. The Trump administration scaled that back. Now the Biden administration's put it back in. So they're doing everything they can to hobble production. They've made it very, very difficult to get leases on federal land for oil and gas. We can see where that's going. But then you have to look, and we all know what happens when you have these alternative energy sources. They're utterly unreliable. We saw what happened in Texas last winter. We've seen what's happened in California with the outages because of their reliance on these so-called renewable energies. We see it in the United Kingdom. We see it in Europe. They're going to have a terrible winter. Now let's get to the truth about renewables. This is, again, something that's got to be stopped. Because otherwise it's going to drain a lot of resources and ultimately impact the value of equities. Let's go to the truth. If you take a 100 megawatt gas turbine, natural gas turbine, that turbine is about the size of a residential house and can provide electricity for about 75,000 homes. So remember that. A turbine, natural gas, size of a house, 75,000 customers. Now, the equivalent wind farm to provide that kind of electricity for 75,000 homes reliably would be 10 square miles versus the size of a residential house. It will require 20 turbines, each bigger than the Washington Monument. It would require 50,000 tons of concrete, 30,000 tons of iron ore, 900 tons of non-recyclable plastics. And of course, with energy, as we've all seen with Texas and elsewhere, if you don't have storage, you're going to be in trouble. So if you want proper storage for 24/7 reliable electricity in that wind farm, that'll take, get this, 10,000 tons of Tesla class batteries. And that's just 10,000 tons. That's just for one wind farm. Multiply that by a couple of thousand here and thousands more around the world. You can see the utter ridiculous and destructiveness of this push for so-called renewable energies. Just look what it would do for mining. These things require a lot of minerals. Mines are not easy to sink. They take up a lot of earth. Lithium, they'd have to increase the output of lithium 40-fold, nickel 20-fold, graphite 25-fold, massive increase in cobalt. Oh, guess who controls cobalt in the world in terms of refining cobalt? China. So this thing just doesn't work. Nonetheless, they're going full bore on these so-called renewables, which is going to be a real disaster if they're not stopped in terms of what it does to the future of this economy. Now, in the terms of regulations, already mentioned what they're doing on the energy side. They're doing it on the union side, which is going to be crushing small businesses. And also, we've already seen supply chains. What happened with those COVID lockdowns is that it made people begin to realize just how sophisticated and utterly complicated supply chains are in the modern world. You just don't turn them on and off like a faucet or a light switch. And so let's look at what's happening. Let's take California. The ports there in Long Beach and Los Angeles, that's where 40% of our imports come from, critical parts and the like. A lot of Christmas toys sitting out in that harbor because they can't unload them. Now, one of the big reasons why they can't unload them is that Los Angeles and Long Beach have a rule, and that is you can't stack empty containers. Now, normally what happens is a truck delivers a container on for export. They then pick up a container with imports and go about delivering them. Well, because of the disruptions of COVID, we didn't get a lot of exports as we normally would, and then you ended up with a lot of empty containers. Where do you store them? Now, normally in a port, you just stack them one on top of the other. But in Los Angeles and Long Beach, you can't. If it's above two, you are in trouble. You're committing a crime. Now, a fellow named Ryan Peterson, who heads up a great new freight forwarding company, came up with a solution. Long Beach and Los Angeles should temporarily waive that anti-stacking rule and allow the containers to be stacked. So that way, the trucks can then the trucks then have the space, since they're not storing these empty containers. The trucks can unload those empty containers. You get to take filled up containers from those ships and start delivering them. Well, fortunately, when Peterson wrote a tweet that became a tweet storm, the city of Oakland said, okay, well, not Oakland, but Long Beach said, okay, you can, instead of restricting stacking to 2, you can do 4. Well, that's a start, but Los Angeles still is not doing it. So those kinds of basic changes, allowing temporarily stacking. Peterson also has other ideas, such as temporary storage yard of 500 acres within 100 miles of those 2 ports, temporary to store empty containers, make sure we get those containers moving. And yet, what is the government doing out there? And to the applause of the Biden administration, they're imposing now fines on shippers for the delays. They help cause the delays, but they're going to end up putting on fines. What's that going to do? That's going to hurt. That's going to put out of business some of the smaller shippers with those kinds of massive fines. And guess who's only going to pay the fines? You, the consumer, in the way of higher prices. Trucking regulations. A lot of unnecessary regulations there, or at least should be suspended. Allow truckers to drive an extra hour a day at the proper pay. Allow 18-year-olds to go across state lines driving a truck. Silly kind of regulations, temporarily, at least temporarily waive them so we get these bottlenecks moving again. Fortunately, Florida and Texas have made clear that their ports are open 24/7. And even though it's more expensive to take these container ships to Florida and Texas, it's not going to be so expensive given the massive cost of just sitting out in the harbor in the dead of water, not able to deliver those goods and therefore not getting the shipping fees you need to stay in business. So that'll help a little bit. And by the way, Florida and Texas, they say their ports will be open 24/7. Now, in Long Beach and Los Angeles, the Biden administration, we're going to have them, we'll operate 24/7. Well, only one terminal out there is operating 24/7. The rest are not. And that one little terminal is only doing it 4 days a week. Hello. And this way, when we step back and look at Operation Warp Speed, where the private sector was really in charge. Yes, they worked with the government, but the private sector was in charge. We saw what looked like miraculous results in terms of getting things done quickly. But we haven't seen that kind of a push and undoing these bottlenecks, except punitive measures like fines, which is going to just fill up government coffers at the expense of all of us. So in terms of what this is going to lead to, and the danger here is the government's going to be looking for scapegoats. Oh, look at those greedy shippers, got to find them. Look at those greedy stores, they're charging too much. They're going to try to put on rationing, they're trying to put on allocation. You can only sell so many items to a certain number of customers. More and more government control. So the more the government messes things up, the more of the power the government takes upon itself in the name of fighting it. So in terms of the supply chain problems, if the government would step out of the way, do some common sense temporary measures, these bottlenecks could quickly be taken care of. But so far, they're just seeming to drag their feet. Not good for the future. Now, in terms of regulation, a key thing is who you appoint. And there's one appointment which just epitomizes this administration, which if it's not curbed is going to really hurt things in the future. There's an office called the Office of the Controller of the Currency. It's a regulatory agency, not well known, but they oversee 1,200 financial institutions, very, very powerful institutions for banks and financial institutions. And guess who the Biden administration has nominated to head this critical agency with a lot of discretionary power? A person called Soleil Omarova. Now, Soleil Omarova came from the former Soviet Union. Fine. But the problem is she still thinks the Soviet Union was a pretty good place. She wrote a thesis for Moscow University. The Congress asked to see it because it praised communism, praised Marxism. But strangely, Moscow University says, it's disappeared. It was burned in a fire. And she says, I don't know what happened to my copy. The dog must have eaten it. And she's already on record wanting the government to take over the banking system. She wants all consumer accounts to be controlled by the Federal Reserve. She wants government regulators to determine where loans go. Now, she apparently hasn't gotten the news the Soviet Union fell 30 years ago, but nonetheless, she's been nominated to head up this critical agency, hostile to banking, hostile to free markets, and still enamored with the Soviet Union. Imagine a regime that killed tens of millions of people, she's still singing its praises by saying, well, the pay between men and women are more equal there than they are here in the United States. Ay, ay, ay. But that's the kind of attitude that pockmarks this administration. Another area, obviously critical, that's going to get more and more attention, I've touched on it, but that is the area of healthcare. They want to control drug prices for Medicare and Medicaid. That sounds very nice, very, very expensive, these drugs. But the way they're going about it is that it would kill innovation in this country. Ask yourself a very simple question. Why is it that the United States does so much better than other countries in terms of innovation in new medical devices, new pharmaceuticals, and the like? And the answer is, even though we still have a system that needs reform, it's better than what you have in Europe with their suffocating single-payer systems. Once upon a time, decades ago, Europe was a great font of innovations in pharmaceuticals. They're still pretty good, but nothing like they were before. And when you have a government payer system or effective government control, more and more government control, you get less innovation. They crush innovation. And the tragedy is right now, it's really a very, very inspiring thing. But the tragedy will be is if these new things that are coming along in healthcare are short-circuited, and other things that could be coming along would be short-circuited by smothering government regulations, the type that Bernie Sanders and the Biden administration want to impose. For example, big things coming along, means to detect lung cancer and other kinds of cancers before traditional symptoms show up. As we all know, the earlier you capture that disease, the better chances you have for surviving that disease. So big breakthroughs are coming there. We all know what's happening with immunotherapies in treating lung cancer. Now imagine being able in a few years to replace hearts, lungs, livers, kidneys, like we do a tire. Instead of waiting today, hoping somebody dies or has a terrible accident, and you can wait for an organ. Imagine being able to not have to worry about that anymore. You can get a perfectly good replacement. That just sounds unbelievably good. There's surgical breakthroughs coming. Ultrasound surgeries now can be done on the brain in a way that they don't have to go inside the brain to be able to perform that surgery. Miraculous. And already in Parkinson's disease, there's a type of surgery now. The FDA has been dragging its feet on it, but tens of thousands of people have had it, where this kind of surgery doesn't cure the disease, but stops the tremors, thereby improving the quality of life. These are the kinds of breakthroughs we want to see in the future. So what does the future look like in terms of healthcare? Well, it can go in several different directions. One is a free market direction, just the opposite of what this administration is doing. The forces are there for a free market direction. Most companies now have high deductible plans. People are becoming very aware of what things cost. And so they're rising up services to bring transparency. Imagine government having to put in regulations for hospitals to post prices. They don't have to do that for hotels or airplanes. You go online. But that's beginning to change because people now are paying more out of pocket, and therefore they want true information. So go online and go to something like Sesame Health, and you'll see almost a Expedia Priceline kind of services for certain kinds of procedures and doctors. You're going to see more of it. The Surgery Center of Oklahoma started years ago. What they do there, they provide numerous kinds of surgeries, but they don't take insurance. It's cash. And but the amazing thing is, their costs are about 1/3 of traditional hospitals. Why? Because they don't have administrative overhead bloat, because they can't rely on third parties for the government or big insurance companies to cover their costs. And so they have board certified surgeons, excellent results. Sometimes traditional hospitals refer patients to them. And and all their prices are posted online. So you want a knee replacement, you can go online, see all the particulars, get a package cost, and if the surgery happens to cost more, they eat the extra cost. True transparency. No surprise, they get a lot of business from places like Canada. And a lot of people find that even though they pay out of pocket, the costs are so low that they still end up saving money from a traditional plan. 75% off, 70% off. Yes, that looks very attractive. And the results, the outcomes are as good or better than traditional hospitals. You're going to see more of that kind of thing in the future. So in terms of the stock market and the bond market, thanks to the Federal Reserve, is, I think, going to have a turbulent time in the next couple of years, even though it's performed miraculously in recent years when everyone thought it wouldn't. And on the stock side, expect some choppy waters ahead, even if we kill this terrible bill in Congress. Now, the thing to keep in mind, of course, is that those things are not permanent. Bull markets are not permanent, even though sometimes we tend to think so. Bear markets are not permanent, even though during a bear market, everyone thinks the world's coming to an end. But as somebody said in 2008, the world can only end once, and this is not it. So while the market's going to have some very, very choppy waters, it's not going to be the end of the world. But the key thing is preventing the Federal Reserve from creating a hyperinflation. I should say very serious inflation because of the games that they are playing, keeping interest rates so artificially low. We have negative interest rates, for crying out loud, which has hurts the creation of small businesses. And while this administration is doing things to hurt the creation of new businesses, which means we're going to get fewer big new companies in the future, since they all start out small. We do this better than any other country in the world. Short term, they're going to do a lot of harm. And that's why this election tonight is so important, and also why the 2022 elections and the 2024 elections are going to be critical. But in the meantime, we're going to have to work hard, not only to derail big bad bills like the kind that the Biden administration and the far left and Bernie Sanders are trying to push through Congress, but also what they're doing on the regulatory side and the rules they're making and the people they try to slip in, like that Saleh Amarova, people like that. And so we've got our work cut out for us. So on the terms of the stock market, just brace yourself. But in the meantime, fight, and we'll have much, much better days ahead. We'll get through this terrible period. Thank you.
Thank you, Steve, very much for that wonderful presentation. Along with it comes a lively chat room, and I do have a few questions that I'd like to put forth here for you.
Great, thank you.
Okay. What do we need to do to actually decrease U.S. corporate tax to 15% in order to promote development?
Well, what should be done, and I hope in an election or two we'll get it done, is simplify the code the way the flat tax would. Just throw it out, have a single simple rate. On the business side, that would mean you would deduct the costs of running your business. And the flat tax proposal I had, and there are other similar kinds of proposals, my rate was 17%. Some feel they can get it down to 15%. And by having that kind of simplicity, you wouldn't have to have a situation where companies spend inordinate amounts of time and money trying to shuffle assets around, trying to reduce their rate. So the basic thing is if you make it, you pay it. Now, 30 countries have various forms of flat taxes, which have worked pretty well. Hong Kong, which is struggling to survive against the Chinese takeover for years before that takeover, crushing of a democracy there, free for the freedoms there that Hong Kong people enjoyed. Hong Kong had a tax system, still has the vestiges of it, which was very simple on both the personal and the corporate side. And the place prospered. Same is true of Singapore today. So make it simple, make the rate low, and businesses can focus on doing real things rather than trying to cope with this immensely incomprehensible code. And especially important for small businesses. The 2017 Tax Act didn't do enough for small business. The rate should have been cut more for more small businesses. So I hope when we get control again, which I think we will, we do it right. Make it simple, make it low, and commerce will blossom.
Thank you, sir. Now, can you provide your prediction on the impact of Glasgow climate on the U.S. real productive oil and gas energy sources by chance?
The conference itself will have no impact. The impact is coming from what this administration already is doing. Now, they may use the cloak of Glasgow for more of their barbarous desecrations and assaults on the energy industry, but they're going to do that anyway. And what that confab does is, one, it tries to engage in, and previous ones, that the end of the world is at hand. And so they take current trends and extrapolate them in the future, assuming that people will do nothing. Well, if people did nothing, Holland today would be under about 100 feet of water. It isn't. People respond to changes, and we'll do the same thing with any kinds of changes in the climate. But if you look at deaths from terrible climate disasters, hurricanes and the like, they're down over 95% in the past century. Why? Because we have better predicting in terms of weather, we have better structures and dealing with them. So again, the number of storms have not gone up. They have the ups and downs, but there's been no long-term trend and a big increase at all. You look at California, we think it's constantly on fire. Much of that is due to bad land management. So the Glasgow confab, they all go out there in their private planes, have a nice time, a lot of nice food. And so developing countries say, give us money. Africa's asking for, starting in 2030, $1 trillion a year to make so they don't go for fossil fuels. And so promises are made and not much gets done. In terms of emissions, the US is the best country in the world by far because we haven't gone totally bonkers on alternative energies as Germany did, which now has 2 to 3 times the electricity costs of the US and is relying on coal as never before because they shut down their nuclear plants. you're worried about emissions, natural gas and nuclear power are the best, cleanest sources. But you can't tell that to the extremists.
All right, sir. And let's go ahead and end on this question, if we could, please. People would like to know, based on the current situation of the economy and the markets, what areas of investments do you recommend that they invest in that would be beneficial and safe should we continue to have adverse situations impacting the economy?
Well, for retirement funds, especially for younger people, you should stay fairly invested in the market. I know that sounds kind of strange, but this country always comes back. And over time, you'll do very well. For your other kinds of investments, you should always have a smattering of gold, not as an investment, but really as an insurance policy against the bad behavior of government. You should look at hard assets too, as a way to invest. But as you prepare for a kind of higher inflation with hard assets and the like, know that the environment can change. Now, commercial real estate, in a lot of parts of the country, there's been overbuilding. So you're going to have to do a careful analysis, not just of an industry, but of company by company to cope with a potential disaster from inflation. But the key thing is not to panic and watch what the Fed is doing. And remember, in the 1970s, you did very well with energy for a while. And then when inflation was conquered, boom, that crashed. So you have to be very nimble, because inflation eventually will be tackled, and investments that look good when prices are rising suddenly don't look so good. So it's just a lot of scut work. And always keep, even though this will sound contradictory, keep a smattering of cash, even though inflation will be eating away at it, because you want some liquidity, some nimbleness to be able to respond to opportunities. And areas of opportunity, I touched on one, is healthcare. A lot of great things are being done. If we keep the government at bay in healthcare, there'll be numerous good startups coming there. Areas like the cloud, artificial intelligence, amazing things are going to be coming along. So if you have that venture capital bent, you're going to have a lot of opportunities, even in this kind of terrible environment that the government has been giving us.
All right. Thank you so much, Steve, for joining us today.
Thank you. Appreciate
All
it.
right.
Thank you. So.